I got a letter last week from a school teacher in Nebraska. She'd taken $23,000, her entire savings, and bought gold coins, physical gold. She keeps them in a safe deposit box at her local bank. When I asked her why, she said, "Mr. Buffett, I'm scared. The dollar is dying. Gold is the only thing that will protect me." That conversation has been replaying in my mind ever since. You know, I've been investing for 70 years now. I've seen every kind of mania you can imagine. I've watched people throw money at tulip bulbs, at tech stocks with no earnings, at houses they couldn't afford, at cryptocurrencies that produce nothing. And through all of it, there's been one constant refuge that people run to when they're afraid: gold. Right now, that gold is trading around $2,600 an ounce. That's near all-time highs. The gold bugs are telling everyone who will listen that it's going to 10,000, maybe 20,000. They say the dollar is collapsing, that the Federal Reserve is destroying our currency, that gold is the only real money. And let me be clear about something. These aren't stupid people making these arguments. Some of the smartest investors I know own gold. Central banks are buying gold at record rates. Regular folks are pulling money out of their savings accounts and converting it to gold bars. Here's what concerns me, though. I'm looking at the same fear I saw in 1980 when gold hit $850 an ounce, and everyone said it was going to 5,000. That I'm seeing the same panic buying, the same certainty that paper money is worthless, the same conviction that this time is different. Well, let me tell you what I see when I look at gold. And more importantly, let me show you what I don't see. But before I do that, I need to be fair to the gold investors, because they're not crazy. They have real reasons for what they're doing. And if you're going to understand why I think gold is a terrible long-term investment, you need to first understand the bull case. You need to hear their strongest arguments. So let me start there. The people buying gold right now will tell you they're not speculating. They'll say they're protecting themselves. And when you listen to their arguments, I'll be honest, they make a compelling case. First, they'll point to monetary policy. Look at what central banks have done over the past 15 years. The Federal Reserve's balance sheet went from less than $1 trillion before the financial crisis to nearly $9 trillion at its peak. We printed money on a scale never seen in American history. The European Central Bank did the same thing. Japan's been doing it for decades. Recent reports show that the M2 money supply in the United States increased by roughly 40% from early 2020 to late 2021. That's an astronomical expansion in just 2 years. The gold bugs look at that and say, how can the dollar maintain its value when we're printing this much money? And you know what? That's a fair question. Second, they'll tell you about real interest rates. When you adjust interest rates for inflation, real rates have been negative for long stretches over the past decade. If you're earning 2% in a savings account, but inflation is running at 4%, you're losing purchasing power every single day. Gold doesn't pay interest, but it also doesn't lose value to inflation the same way cash does. Or so the argument goes. Third, they'll point to geopolitical instability, wars in Ukraine and the Middle East, tensions between the United States and China, the possibility of a conflict over Taiwan. When the world gets scary, gold traditionally performs well. It's been a safe haven for thousands of years. It's not going to disappear. You can't print more of it. You can hold it in your hand. Fourth, they'll show you the charts. Gold has gone from under $300 an ounce in the early 2000s to over $2,600 today. That's an 8-fold increase in roughly 20 years. Anyone who bought gold in 2001 and held it has made real money. And they're not selling now. They're buying more. Fifth, and this is where they really get going, that they'll talk about the dollar losing its reserve currency status. They'll say that China and Russia and other countries are moving away from the dollar for international trade. They'll point to the BRIAS nations talking about creating their own currency. They'll say the petrodollar system is ending. And when that happens, they argue the dollar will collapse and gold will soar. Here's the thing. Some very smart people believe this. Tell that. Ray Dalio has talked about owning gold as part of a balanced portfolio. Stanley Druckenmiller has owned gold at various points. Central banks around the world, particularly in countries like China, Russia, India, and Turkey, have been accumulating gold reserves at unprecedented rates. Recent data shows central bank gold purchases reached their highest levels in over half century. And these aren't wild-eyed conspiracy theorists. These are sophisticated institutions with teams of economists and analysts. They're buying physical gold and storing it in vaults. That they're reducing their dollar holdings and increasing their gold holdings. the gold bugs will also tell you about wealth preservation. They'll point to families in places like Lebanon or Venezuela or Argentina who saved themselves from total financial ruin by holding gold when their currencies collapsed. They'll tell you about people who survived the Weimar or hyperinflation in Germany because they had gold. That they'll show you historical examples where gold maintained purchasing power through wars, revolutions, and currency collapses. Moreover, they'll make the point that gold is no one's liability. If you own a bond, you're depending on someone to pay you back. If you own a stock, you're depending on a company to perform. If you hold cash, you're depending on the government not to devalue it. But gold just sits there. It doesn't depend on anyone's promise. It doesn't require trust in any institution. They'll also argue that gold is deeply embedded in human psychology. For thousands of years, across every culture, gold has been valued. It's been used as money, as jewelry, as a store of wealth. There's something primal about gold that transcends economics. People will always want it. That demand isn't going away. And finally, they'll tell you this. Look at government debt. The United States has over $34 trillion in national debt. That number grows by trillions every year. There's no realistic plan to pay it down. The only way out is to inflate it away, to print money until the debt becomes manageable in nominal terms, but worthless in real terms. And when that happens, gold will protect you. Now, all of that sounds pretty good, doesn't it? I mean, if you lay out the bull case like that, you can see why smart people own gold. You can see why that teacher in Nebraska bought gold coins. The logic seems sound. The historical precedents seem clear. The current environment seems perfect for gold. But here's the problem. Stop me if you've heard this one before. Actually, don't stop me, because I'm going to tell you anyway. In my 70 years of investing, I've learned something crucial about human nature. When people are scared, they'll believe almost anything that promises safety. They'll pay any price for what they think is protection, and they'll ignore the most basic questions about what they're actually buying. Look, I understand fear. I've lived through plenty of scary times. I remember the stagflation of the 1970s when everyone was convinced America was finished. I remember the Cuban Missile Crisis when we thought nuclear war was imminent. I remember 2008 when the entire financial system nearly collapsed. And you know what happened every single time? The people who made the most money were the ones who asked the simple questions, the ones who looked at what they were buying and said, okay, but what does this actually do? So let me ask you something, and I want you to really think about this. What does gold do? Now, before you answer, let me be specific about what I mean. I don't mean, what could you potentially sell it for? I don't mean what someone else might pay for it. I mean, what does gold itself produce? What does it generate? What value does it create? Because that question matters more than anything else when you're talking about investing your money. And that's where everything changes when we talk about gold. Let me tell you about productive assets. I've said this for years, and I'll keep saying it until I'm gone. When you invest, you should be buying things that produce value, things that create wealth, things that will generate more money tomorrow than they're worth today. Take a farm. If you buy a farm today and you couldn't sell it for 20 years, what happens? Well, every year that farm produces crops. Those crops get sold. You earn money. If it's a good farm in good soil with decent rainfall, you might earn 5 or 6% of the farm's value every single year. After 20 years, you've collected a substantial portion of your original investment in cash, and you still own the farm. The farm has fed people. It's created value. It's been productive. Or take an apartment building. Same principle. Every month, tenants pay rent. That rent comes to you whether the stock market is up or down, whether there's a war or peace, whether gold is at $500 an ounce or $5,000. The apartment building produces income. It houses people. It serves a purpose beyond just sitting there. Now, let me talk about businesses. When you buy a share of Coca-Cola, you own a tiny piece of a company that sells over 2 billion servings of beverages every single day. That company generates cash. It pays dividends. It reinvests in growth. It employs hundreds of thousands of people who create value every single day. If you bought Coca-Cola stock and couldn't sell it for 20 years, you'd still collect dividends year after year. The company would still be producing and selling products. That's what I call a productive asset. Something that creates value just by existing. Something that generates returns without requiring someone else to pay you more than you paid. Here's the thing, though. When I look at gold, I see none of that. Zero. If you buy 100 ounces of gold today and put it in a vault for 20 years, what do you have at the end 100 ounces of gold, it doesn't breed. It doesn't produce crops. It doesn't generate rent. It doesn't pay dividends. It doesn't create anything. Let me make this really concrete. Imagine we take all the gold ever mined in human history. All of it. That's roughly 200,000 metric tons. Do you know how big that is? If you melted it all down, it would form a cube about 70 feet on each side. You could fit it all in a single baseball stadium. Now, at current prices, that cube of gold is worth somewhere around $14 trillion. 14 trillion. That's a staggering amount of money. But here's what I want you to understand. That cube just sits there, and it doesn't produce anything. It doesn't do anything. It's just there, shiny, heavy, inert. Now, what else could you buy with $14 trillion? Well, you could buy all the farmland in the United States, all of it. Every farm, every acre, everything. That's worth roughly $3 trillion. So let's do that. Then with the remaining $11 trillion, you could buy 15 companies the size of a Walmart. 15 of them. Now, think about what you'd own. You'd own all the farmland in America, producing enough food to feed hundreds of millions of people every single year. You'd own 15 of the world's most successful retailers, generating hundreds of billions in revenue and tens of billions in profit annually. And 100 years from now, all that farmland would still be producing crops. And 70, and those 15 Walmarts would have paid out trillions in dividends and would still be operating stores. Or you could own that cube of gold still sitting there, still shiny, still producing nothing. Which would you rather have? You see, this is what I mean by intrinsic value. A productive asset has value because it produces something. It generates cash flows. It creates wealth. Its value comes from what it does, not just from what someone else might pay for it. Gold has no intrinsic value in that sense. Its value is entirely dependent on the next person being willing to pay you more than you paid. That's not investing, that's speculation. It's the greater fool theory. You're buying something, hoping a greater fool comes along and pays you more for it. Now, the gold bugs will tell me I'm missing something. They'll say, but Warren, gold holds its value through inflation. Okay, let's test that. In 1980, gold hit $850 an ounce. Adjusted for inflation, that's about $3,000 in today's money. Gold today is at $2,600. So someone who bought gold at the peak in 1980 has actually lost money in real terms over the past 44 years. That, meanwhile, if you bought the S&P 500 in 1980 and reinvested dividends, you'd be up over 80 times your money, 80 times. Not because of speculation, because those companies produced value year after year. They generated earnings. They paid dividends. They grew. They'll also tell me, but Warren, what about crisis? That gold protects you during crisis. Well, let me ask you this. During the financial crisis of 2008, and the people that, when the world was supposedly ending, what happened to gold? It dropped from over $1,000 to under $700. It fell 30%. Some protection. And here's the deeper problem with the crisis argument. If you're buying gold because you think civilization is going to collapse, then you need to ask yourself what good gold will do you. If we're in a Mad Max scenario where paper money is worthless, do you really think people are going to trade you food and water for shiny metal? They want things they can actually use: tools, seeds, medicine, skills. Gold only has value in a functioning society. But if society is functioning well enough that gold has value, then productive assets will perform better than gold over time. It's a paradox that the gold bugs never seem to address. Let me give you another way to think about this. Charlie Munger used to tell me, show me the incentive and I'll show you the outcome. So what's the incentive structure around gold? If you own a farm, your incentive is to maximize crop production. If you own a business, your incentive is to maximize profit. You're constantly trying to create more value. If you own gold, your incentive is what? To hope it goes up. To root for disaster so you can say, I told you so. That's not productive. That's parasitic. Look, I get it. I understand why people are scared. I understand why they want something tangible. But fear is a terrible investment advisor. Fear makes you pay too much for protection. Fear makes you ignore basic mathematics. Fear makes you confuse motion with progress. And right now, at $2,600 an ounce, with everyone talking about gold going to 10,000, I see fear. I see people running toward something without asking the most basic question. What am I actually buying? Now, if this sounds familiar, it's because I've seen it before. Let me take you back. It was 1980. I was sitting in my office in Omaha, and gold was all anyone wanted to talk about. It had gone from $35 an ounce in 1970 to over $800. 20-fold increase in a decade. People were lining up outside coin shops. They were melting down jewelry. They were convinced gold was going to $5,000. Why were they so convinced? Same reasons people are convinced today. Inflation was running at double digits. The Iranian hostage crisis had Americans feeling powerless. The Soviet Union had invaded Afghanistan. Interest rates were skyrocketing. The dollar was supposedly dying. Sound familiar? Gold became more than an investment. It became a religion. People talked about it with missionary zeal. If you questioned gold, you were naive. You didn't understand economics. You didn't see what was really happening. I remember one fellow telling me, Warren, you're invested in businesses that depend on paper money. When the currency collapses, all your stocks will be worthless. Only gold will survive. He was absolutely certain. He'd put everything into gold. Then something happened. Paul Volcker raised interest rates to nearly 20%. He broke the back of inflation. The crisis passed. And you know what happened to gold? It crashed. Within 3 years, it was back under $400. It stayed depressed for 20 years. 20 years. Meanwhile, if you'd bought the S&P 500 in 1980, you would have experienced the greatest bull market in American history. Companies like Microsoft and Apple and Walmart and Home Depot were just getting started. They created trillions in wealth. They changed how people lived and worked and shopped. And that fellow who put everything in gold, last I heard, he was still waiting to break even. You know what he missed? He missed the personal computer revolution. He missed the internet revolution. He missed the rise of global trade. He missed 30 years of productivity gains and business growth and wealth creation, all because he was sitting on a pile of metal waiting for civilization to collapse. Here's what I learned from watching that whole episode. When everyone agrees that the sky is falling, usually 70, it doesn't. When the consensus is that only one thing can save you, usually that thing is overpriced. And when fear drives investment decisions, usually those decisions look foolish in hindsight. But let's go even further back, because the gold story is much older than 1980. For most of human history, gold was actually money. You could exchange it directly for goods and services. But then something interesting happened in the 20th century. We moved off the gold standard. First gradually, then completely when Nixon ended dollar convertibility in 1971. And you know what happened after that? The greatest period of economic growth and wealth creation in human history. When we freed ourselves from the constraint of tying our money supply to how much shiny metal we could dig out of ground. We unleashed incredible prosperity. Think about what the world looked like in 1971 compared to today. Life expectancy has increased by over a decade globally. Extreme poverty has declined from over 35% of the world's population to less than 10%. Literacy rates have soared. Access to clean water, electricity, healthcare, education, all dramatically improved. Did that happen because we had more gold? No. It happened because we built businesses, infrastructure, and institutions that created real value. It happened because we invested in productive assets, not inert metal. Now, I know what the gold bugs are thinking. They're saying, but Warren, that prosperity came at the cost of currency debasement. The dollar has lost over 95% of its purchasing power since 1913. Well, yes and no. The dollar buys less than it used to in absolute terms. But look at what the average person can afford today compared to 1913. They have air conditioning, cars, computers, smartphones, access to the sum of human knowledge in their pocket. Their standard of living is vastly higher despite the debasement of the currency. That's because wealth isn't about money. It's about productive capacity. It's about our ability to create goods and services that improve people's lives. And gold, that sitting in a vault, contributes nothing to that. Let me tell you about another fascinating historical parallel. In the 1600s, there was something called tulip mania in the Netherlands. Tulip bulbs became a speculative frenzy. At the peak, a single rare tulip bulb could cost as much as a house. People were mortgaging their homes to buy tulips. They were absolutely convinced that tulip prices could only go up. And for a while, they were right. Prices kept rising. Everyone who got in early made money. The people who questioned it looked foolish until suddenly the music stopped. Prices collapsed. Fortunes were destroyed overnight. Now, tulip bulbs at least produce something. They grow into beautiful flowers. They have aesthetic value. But as investments, they were worthless because their price was divorced from any fundamental value. It was pure speculation, pure greater fool theory. Gold isn't quite as absurd as tulip bulbs. It does have some industrial uses. It's used in electronics and dentistry. But those industrial uses account for only about 10% of annual gold demand. That the rest is investment in jewelry. And the investment demand is almost entirely based on the belief that someone else will pay more later. That's not so different from the tulip buyers when you think about it. They were buying bulbs not because they wanted gardens, but because they thought they could sell to someone else for more money. Same psychology. Same outcome eventually. What worries me most, though, is when I see regular people getting caught up in this. Not hedge fund managers who can afford to lose money on speculation. Not wealthy individuals who are buying gold as a small portion of a diversified portfolio, but school teachers and plumbers and nurses who are putting their life savings into gold because they're scared. Those are the people who get hurt when the cycle turns. And the cycle always turns. Now, let me show you the numbers, because this is where it gets really interesting. Current market data shows gold is trading near all-time nominal highs. Well, let's put that in context. The gold market in total is worth roughly $14 trillion globally. That's all the gold, ever mind, all the gold in central bank reserves, all the gold in jewelry, everything. 14 trillion is a lot of money, but compare it to the total value of global stock markets, around $100 trillion, or global real estate, about 300 trillion, or total global wealth, roughly 500 trillion. Gold represents less than 3% of global wealth. That sounds reasonable until you think about what it actually produces, which is nothing. So 3% of global wealth is tied up in an asset that generates zero cash flow, zero dividends, zero economic value. Now, here's where it gets more interesting. Recent reports show that global central bank gold purchases have surged. Central banks bought over 1,000 metric tons of gold last year, the highest level in decades. Countries like China, Russia, India, Poland, and Turkey have been accumulating reserves at unprecedented rates. The gold bugs look at that and say, see, the smart money is buying gold. But let me ask you something. What are those central banks really doing? They're diversifying away from dollars. And they're hedging against the possibility of currency instability. They're buying insurance. Insurance is fine. I believe in insurance. I have insurance on my house. But I don't think of my house insurance as an investment. I pay premiums hoping I never have to use it. Central banks buying gold are paying premiums in the form of holding a non-productive asset. They're not expecting to make money on gold. They're expecting not to lose everything if their currency holdings collapse. That's a very different proposition from what the school teacher in Nebraska is being told. She's being told gold is going to make her rich. Central banks aren't buying gold to get rich. They're buying it as a hedge against catastrophe. Let's look at the price action. Gold bottomed around $250 in 1999. Since then, it's risen over tenfold. That's an annualized return of about 9% over 25 years. Not terrible, right? Except look at what else you could have bought. The S&P 500 over that same period returned about 8% annually, including dividends. Pretty similar to gold. But here's the difference. Stocks paid you dividends along the way. Gold cost you money to store. And more importantly, that 25-year period included some of the most favorable conditions for gold imaginable. We had the financial crisis of 2008. We had zero interest rates. We had massive money printing. We had multiple wars and geopolitical crises. We had a global pandemic. These were perfect conditions for gold to outperform. And it basically matched stocks. Barely. Now, imagine the next 25 years. Imagine we don't have a financial crisis. Imagine interest rates stay positive. Imagine the dollar remains the reserve currency. What happens to gold then? Let's also talk about the supply-demand dynamics. Recent industry data suggests annual gold mine production is around 3,500 metric tons. That's about 1.5% of total above ground gold stocks. So the supply grows slowly. Gold bugs point to this as proof of scarcity. But here's what they miss. Demand for gold doesn't come from people who need it for useful purposes. It comes from people who want to speculate on it or hide wealth. That demand is entirely psychological. It can vanish overnight. In contrast, demand for food is real. Demand for housing is real. Demand for energy is real. Demand for the products that businesses produce is real. Those demands don't disappear because people lose confidence. You still need to eat. You still need shelter. You still need electricity. Gold demand is almost entirely confidence-based, and confidence is fickle. Let me show you something else that troubles me. The futures market for gold shows something called contango, where futures prices are higher than spot prices. That tells you the market expects gold prices to rise. But it also tells you something else. The cost of holding gold is significant. If you buy physical gold, you need to store it securely. That costs money. You need to insure it. That costs money. You need to verify it's real. That costs money. And while you're holding it, you're earning nothing. You're actually losing money every year to storage and opportunity cost. If we assume inflation runs at 3% annually and storage costs another 1%, you're losing 4% per year in real terms just by holding gold. That means gold needs to appreciate by at least 4% annually just for you to break even in real terms. Meanwhile, a productive business is earning returns and growing. It's swimming with the current and not against it. Here's another number that should concern gold investors. The ratio of gold to the S&P 500 in 2011, when gold peaked at $1,900, you needed about 1.3 ounces of gold to buy 1 unit of the S&P 500. Today, at current prices, you need less than half an ounce. That means stocks have dramatically outperformed gold over the past 13 years, despite all the money printing and all the crises. And here's what really gets me. Market data shows retail investors are piling into gold ETFs at near record rates. When I see that, I think of something I learned a long time ago when taxi drivers are giving you stock tips. It's time to sell. When school teachers are buying gold coins, it's time to be cautious. Not because school teachers are dumb. They're not. But because by the time regular people hear about an investment opportunity and feel confident enough to act on it, the smart money has usually already positioned itself. The opportunity, if there ever was one, is gone. Let me give you one more set of numbers. According to financial data, the correlation between gold and stocks has been increasing. That means gold has been moving more in sync with the stock market. That's problematic for gold investors who think of gold as a hedge against stock market crashes. If gold and stocks fall together, what's the point of owning gold? You're holding a non-productive asset that doesn't even diversify your portfolio effectively. During the COVID crash in March 2020, gold initially fell along with stocks. It recovered later. But the point is this: when people really need cash, they sell everything. Gold is no exception. Think about what that means. You're holding gold as insurance against catastrophe, but when catastrophe strikes, everyone tries to sell their gold at the same time to raise cash. The price plunges, some insurance. Now watch what happens next, because this is where things get really precarious. Let me show you exactly how this ends, because I've seen this movie before, and I know how it plays out. There are several scenarios where gold could face serious downward pressure, and none of them are far-fetched. They're all reasonably likely possibilities. First scenario, interest rates stay higher for longer. If the Federal Reserve keeps rates at 4 or 5% to fight inflation, suddenly bonds become attractive again. You can earn 4 or 5% risk free in Treasury bonds. Why would you hold gold, which pays nothing and costs money to store, when you could earn a guaranteed return in bonds? When interest rates rose in the 1980s under Volcker, gold crashed. The same thing could easily happen again. Higher rates make the opportunity cost of holding gold unbearable. Second scenario, the dollar strengthens instead of weakens. Despite all the predictions of dollar collapse, what if the opposite happens? What if the U.S. economy remains the strongest, most dynamic economy in the world? What if Europe and China face worse problems than we do? In that case, capital flows toward dollars, not away from them. The dollar strengthens. And when the dollar strengthens, gold, which is priced in dollars, typically falls. This isn't hypothetical. We saw exactly this pattern during the strong dollar period of 2013 to 2015, when gold fell from over $1,700 to under $1,100. Third scenario, central banks reverse course. Right now, central banks are buying gold. But what happens if that changes? What if geopolitical tensions ease? What if the dollar remains stable? Central banks could just as easily become net sellers. And given how much gold they hold, even a modest shift from buying to selling would flood the market. Remember, central banks aren't Warren Buffett. They're not value investors looking for the best long returns. They're political entities making decisions based on short-term considerations. What looks prudent today might look foolish tomorrow. Fourth scenario, a substitute emerges. Gold bugs will tell you gold is irreplaceable. But is it? What if cryptocurrencies, despite their own problems, actually do become a better store of value? What if blockchain technology creates a form of digital scarcity that's more convenient than physical gold? That I'm skeptical of crypto for many of the same reasons I'm skeptical of gold. It doesn't produce anything. But younger generations seem more comfortable with digital assets than physical ones. If that trend continues, demand for gold could erode gradually over decades. Fifth scenario, practical alternatives become clear. What if investors realize they can protect against inflation and currency risk by simply owning businesses that can raise prices? What if they figure out that owning productive assets is better than owning inert metal? That This is the most likely scenario in my view. Over time, people learn. They figure out what works. And what works is owning productive assets that generate real returns. Here's what really keeps me up at night, though. And it's not any single scenario. It's the fact that at current prices, gold is priced for perfection. It's priced as if all the fears come true. Currency collapse, geopolitical catastrophe, central bank incompetence, everything. But what if just one or two of those fears don't materialize? What if the world muddles through, as it usually does? What happens to gold then? The floor for gold is much lower than people think. Yes, it has industrial uses that create some baseline demand. Yes, it has cultural significance. But strip away the fear premium, strip away the speculation, and what's gold really worth? I'd argue maybe half of current prices, maybe less. Because at the end of the day, it's a metal. A useful metal for certain applications, but still just a metal. It's not magic. It's not going to save you from your own bad investment decisions. So what should you do? Let me tell you. Look, if you own some gold, I'm not telling you to panic and sell it all tomorrow. That's not how I think about investing. Panic is never the right response to anything. But I am telling you to ask yourself some honest questions. First question, why do you own gold? Really, why? Is it because you have a specific rational plan for how it fits into your overall financial picture? Or is it because you're scared and gold makes you feel safer? If it's the latter, you need to recognize that feeling safe isn't the same as being safe at feeling like you're doing something productive isn't the same as actually being productive. Second question, how much of your wealth is in gold? If it's 5% or 10% as a hedge, okay, that's not going to ruin you. But if it's 20, 30, 50%, that's dangerous. That's betting your future on a non-productive asset at near all-time highs. Third question, what's your time horizon? If you're planning to hold gold for 40 years, you're betting that it will outperform productive assets over that entire period. That has never happened in modern history. Why do you think it will happen now? Fourth question, the people that, what would make you sell? If you don't have an answer to that, you're not investing. You're just hoping. Hope is not a strategy. Let me tell you what I'm doing. I'm not buying gold. I'm buying businesses that produce real products and services. I'm buying companies that will still be generating cash flows and paying dividends 20 years from now, regardless of what gold is trading at. I'm buying Coca-Cola, which sells beverages all over the world. I'm buying Apple, which makes products people use every day. I'm buying Bank of America, which facilitates commerce and provides financial services. These companies create value. They employ people. They serve customers. They generate returns. When I look at my portfolio, I can tell you exactly what I own and why each position is there, because I believe the underlying business will create value over time. Not because I'm hoping someone will pay me more for it, but because I know it will generate cash. Can you say the same thing about gold? Can you tell me what value gold creates? Can you tell me what cash flows it generates? I didn't think so. Here's the other thing I'm doing. I'm staying within my circle of competence. I understand businesses. I understand how they make money. I understand how to value them. I've been doing it for 70 years. Gold is outside my circle of competence. I don't understand what drives gold prices beyond fear and speculation. I don't know how to value something that doesn't produce cash flows. So I don't invest in it. That's rule number one of investing. Know what you own and why you own it. If you can't explain your investment thesis to a 12-year-old, you probably shouldn't own it. Let me also tell you what I'm not doing. I'm not trying to time the gold market. I'm not trying to catch the bottom or sell the top. That's a fool's game. Nobody can do that consistently. What I am doing is staying disciplined. I'm sticking to my principles. I'm investing in productive assets and ignoring the noise. And right now, there's a lot of noise around gold. People telling you the dollar is dying. People telling you gold is going to 10,000 or 20,000. People telling you this time is different. Well, you know what? It's never different. Human psychology is the same. Fear drives people to make bad decisions. Greed drives them to chase performance. And in the end, productive assets always outperform non-productive ones. Always. Now, I'm not saying gold will go to zero tomorrow. I'm not saying you should never own any gold. What I'm saying is this, at current prices, with current sentiment, with the amount of speculative fervor I'm seeing, gold is a terrible investment for most people. If you're buying gold because you think you're protecting yourself, you're probably wrong. You're taking on significant risk. The risk that you'll watch productive assets soar while your gold just sits there. You're paying a huge opportunity cost if you're buying gold because you think it's going higher. you're speculating. And speculation is fine if you know that's what you're doing and you can afford to lose money. But don't confuse it with investing. Real investing is about buying productive assets at reasonable prices and holding them long enough for their value to compound. It's about patience and discipline. It's about focusing on what you can control, which businesses you own, rather than what you can't control, what gold prices do. Here's my final warning, and I want you to really hear this. When everyone is running toward something out of fear, you should probably be running the other way. When conventional wisdom says you must own something to survive, that's usually the worst time to buy it. I saw it with tech stocks in 1999. I saw it with real estate in 2006. I saw it with gold in 1980. And I'm seeing it with gold again now. The people who make the most money in investing are the ones who buy what others are scared of and sell what others are desperate to own right now. Everyone wants gold. That should tell you something. I've been investing since the 1950s. I've seen every kind of mania, every kind of panic, every kind of crisis. And the one constant throughout all of it is this: productive assets owned by disciplined investors always win in the long run. Always. Gold doesn't produce crops. It doesn't pay rent. It doesn't generate dividends. It doesn't create jobs. It doesn't improve lives. It just sits there, shiny and inert, waiting for someone to pay more for it than you did. That's not investing. That's hoping. And hope, as I've said before, is not a strategy. So if you're that school teacher in Nebraska with $23,000 in gold coins and in a safe deposit box, here's what I'd tell you. Think very carefully about whether that gold is really protecting you or whether it's just making you feel better while you miss out on actual wealth creation. Because at the end of the day, that's what this comes down to. Do you want to feel safe? Or do you want to be safe? Do you want to hold a shiny metal that does nothing? Or do you want to own productive assets that create real value? The choice is yours. But I know which one I'm choosing. I'm choosing businesses. I'm choosing productive assets. I'm choosing compound returns generated by real economic activity. And I'm passing on gold. You should probably do the same.